Hello and welcome to episode 236 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leakes. Damien, how you doing?
I'm good, Andy. It's so good to be back. I've been looking forward to recording the podcast this week because we've had a break. Andy and I have been on holiday, not together, but we had separate holidays, well deserved, I'd like to think. I am. Andy's comparing tans. You can't see that obviously on the podcast, but Andy is still his lighter self, although older actually. In fact, aren't you, Andy? I'm going to tell the listeners anyway, but Andy had his big birthday, didn't you, while you were away?
The big 4-0. I turned 40. Now, anyone who knows me and who's seen what I look like will have assumed that I turned 40 many, many years ago with a bald head. And I've always been, I don't know if it's lucky or unlucky, in that I've always looked older than I am. So when I was younger, I always used to get in the pubs and stuff.
Yeah, see, I was the opposite end of the spectrum. So I always looked far younger than I am. And the sort of negatives that come with that. But together, as a team, we basically balance each other out. So if we were merging ourselves, we'd probably have a 40-year-old looking person. It would be perfect. So it's good to be back. I had a nice break with the family, which I enjoyed, and now it's back on it. And one of the things we will talk about on the podcast this week is the exciting event that we're doing. And the reason it's related to the holiday, because the team have been working hard while I was away, sitting there in the sunshine, actually sorting out the event, and we're going to talk about that more, but it's been an epic success so far, and so many of you signed up, it's sort of blown the doors off really, so we're going to come on to that. But before we talk about what's on this week's podcast, I just want to mention to learn from my own mistakes. Now, obviously, we do the money stuff, but we always fall foul of things ourselves. No one's perfect. And I managed to spend £40 on my mobile phone when I landed in Turkey without even realising it. So
we haven't spoken about this.
No. Oh, have I not told you?
No.
So I landed in Turkey, and it's always about data roaming. We've done pieces in the past about how you need to turn your data roaming off, and before you get on the plane, even, so you don't have to get to the other country.
You really have got no excuses, because we've done videos, we've done podcasts,
we've done the works, Andy.
We've done articles.
And the thing is, I landed in Turkey on the coach to the hotel, and I didn't really realise that I must have got my phone out of my pocket and checked something, but I believed my minutes were obviously data was included in my package, but obviously Turkey must be not included in being in the EU for the rules of phone roaming. But anyway, I had no intention of using my phone, so I was turning things off. And I got to the hotel and looked straight onto the Wi-Fi. What I didn't realise is I hadn't turned data roaming off when I thought I had. And all through the night, while the phone was in the safe, it was dropping in and out of the Wi-Fi in the hotel. And it must have been downloading something, because about 2 gigs later...
Oh no.
I got a text message from the phone provider telling me I'd spent £40 on downloads all through the night. So there you go. There's a lesson to be learnt there. I learnt the hard way there. Make sure you check your data roaming is off when you're in the UK before you board the plane, because your phone will inevitably do something funny, or could do like mine did, and you could be £40 lighter without any enjoyment of that data. Anyway, on with the show.
Yeah, what are we going to start with? Are we going to be talking about the event?
We're going to talk about the event because we announced it on the last podcast, but we didn't talk much about what was going to be on in the event, who the panelists are, and details about where we are doing the event. But more importantly, there's going to be an after event following the event. So we're going to do a piece on that. I'm going to do a section on investing. It's been a couple of weeks, obviously, and I did a piece on how markets react near all-time highs, if you remember. And this one I'm going to do about lessons learned looking at past losses, so past sell-offs. What lessons can be learned from severe sell-offs in the past. And I'm going to answer a reader question that's based around investing, with the general theme of, is it a good time to start investing?
Good. So what do we start with?
It's the event. Now, the event, for those of you who have not heard about it, it's an event we're doing in the General Assembly, which is in Whitechapel in East London. It's easy to get to. It's on the Circle line. It's on the Metropolitan line. You go to Aldgate Station. The event in the General Assembly is got the title, Build a Champagne Lifestyle on a Lemonade Budget. So
we've had a lot of good feedback on the title, and you didn't get very good feedback from me initially, but I'm on board now.
Now, Andy, we had a number of working titles and different types of event we were going to do, and that was we're going to do different events going forward. So they're going to have different themes probably. We wanted a more rounded title. Andy wasn't massively on board. I loved the title. In fact, it wasn't even me really who came up with that title. It was Justin. It's apparently a well-known phrase on social media platforms, but no one else seems to have heard of it.
That's probably why I didn't like it or didn't know about it, because I'm a dinosaur when it comes to social
I'd never heard it. No one else seems to either. So, building a champagne lifestyle on a lemonade budget. What we're going to be doing is we're going to have a panel discussion. Now, the panel has extended to 5 people. I am on the panel. I'll talk about the other panelists in a second. But to give you an idea, we're going to talk about key things like the best savings and investment strategies, effective budgeting, clearing debt, how to buy your dream home, breaking away from the 9 to 5. So if you've got a job, the daily grind, the 9 to 5, breaking away from that. And of course, don't forget, that is essentially what Money to the Masses came from. It was a side hustle. I don't really like that term, but it was in its early days when I first started it. And of course, the idea of how to retire early. So these are all themes that are wrapped up in people wanting a lifestyle they don't have, but feel they are limited by their means at the moment that they can't achieve it. So we've got 5 panelists. As I said, I am one of them. The others, follow our social media channels because we've been announcing the panelists. You'll find out more about the event as we go along. But one of them is Lynn James. Now, Lynn James runs the blog Mrs. Mummy Penny, and I've appeared on her podcast, actually. She does her podcast show. She's somebody I've known for a number of years, and she has a very interesting story. She used to work in accounting. She eventually became a blogger full-time, and she has in particular she struggled with debt, and she's managed to repay that. She did appear in the Financial Times, the FT recently, talking about how she cleared £16,000 worth of debt. So there's some good stuff there. She's a person who has gone from, like I say, a mainstream job, doing something that she loves, but also along the way having her own struggles, trying to start a business, break the 9 to 5, trying to clear debt, and everything that a mum of 3 boys, in fact, will struggle with. So some things that as a man you can't necessarily empathise with. So she's a very good speaker. She's good fun, because the thing about this talk, it's going to be very good fun. It's going to be interactive, and that's why I want you all there. On that, before I say the next panelist, the number of people coming has blown us away. So we originally had 200 people, a 200 seat event. Well, in 48 hours, that was already sold out.
Yeah.
I say sold out, it is a free event, but we've already had 200 go. So we've managed to expand it to 300. And the last time we checked, after 24 hours of extending that, we'd already got up to 250. And I haven't checked the numbers for the last couple of days. So make sure you go and get your free ticket. If you go to moneytothemasses.com/events, you will find a link. It will go straight through to the event itself. You can register. You can get your electronic ticket. Make sure you come. And there's a thing where people say you get people to pay for an event, they'll definitely come. I know you guys will come no matter what. And it is selling out fast. So as you guys, podcast listeners, I'm in your ears every week. Do come along. It'd be great to meet as many of you, because I do want to meet as many of you as I can. Yeah. And I want my picture taken with you. And Andy's going to be there. So Andy will be there. Andy will more than likely be comparing the whole thing, because as I say, I'm on the panel, and we're going to have the rest of the crew there as well. So as I said, make sure you come along, get your tickets. After the event, it runs from 6:30pm to 7:30pm. It can overrun, so don't worry, we're not going to be booted out at 7:30. There will be drinks there, but we have actually been in contact. Well, a podcast listener got in touch with us because we were looking for a place to go for a drink afterwards, and you guys can all come along. And
champagne and lemonade may be available. We're not quite sure.
Yeah, it could fit with the theme. And we had a podcast listener who coincidentally got in touch with Lauren, who's organising the whole event, to say that he has a pub around the corner. And cut a very long story short, we are going to the after event. Is going to be in his pub. So we're supporting a podcast listener who is running a pub just round the corner. So make sure
details of that pub will be released at the event. So you sneaky people who think, we can meet them at the pub, we won't go to the event. We won't release the pub name, will we? Until the event.
Do you know what, Andy? I was about to, but we're gonna hold it back. Andy, anyway. Andy, everyone's called Andy. Andy runs the pub. So we're gonna go there after the event, and we're gonna have drinks and stuff there. So it'd be great for you all to come. Let's get Andy's pub full. So the other panelists, I'm going to go on to some of the others. Sean McNichol, he runs Money Dashboard. Now, Money Dashboard is one of the budgeting apps out there, and it is like Emma, like Yolt. It's in the same sort of vein, but it's, I think, been around far longer. Because I remember seeing Money Dashboard quite some time ago. And he's coming, obviously, covering much more of the budgeting, the planning side of things. They've done a lot of good research with third parties about how people cope with budgeting and how to do it and the best ways to do it. So he will be on the panel, which will be interesting. We've got Jordan Cox. Now, I'm excited. Jordan Cox is the coupon kid. If you remember the story many moons ago, when he was 16 years old, got £600 worth of shopping in the supermarket for 4p using coupons. So that is how much of a coupon kid, a coupon legend he is. Now, coupons don't exist quite like they did before, but he's still doing it. He has been working for Money Saving Expert for a number of years, actually. And he also, if you remember, there was a story in the press where somebody wanted to go, I think it was something like Manchester to London, and he worked out that he could get a flight via Germany or Holland.
Yeah, I think it was Sheffield to London, and he went via Berlin.
And it was cheaper than getting the train. And that story blew up and was massive. It was Jordan who did it.
Yeah.
So Jordan Cox is a perfect person for all those tricks about money saving. And he's got some great anecdotes. And he's a brilliant guy as well. And
interestingly, he featured in our 100th episode. When we did that 100th episode and we did the outtakes, we had an outtake about the story about Jordan, because I don't know if you remember, I made a funny noise when you talked about Jordan. Anyway, if you haven't heard that, go back to episode 100 where he features in our outtakes.
So Jordan is brilliant. So he's going to be there. Like I say, he's a very fun guy. He's got some really good stories, but he's brilliant at what he does. I don't think there's anybody else better than him. And he's just released a book as well. So that's going to be mentioned, obviously, during the show. And we have also got Emily Smith, who's from Habito. Now, we wanted somebody on the panel who could talk about mortgages and buying property, who does that for a living, so has all the questions that people want in trying to get their next house or their first house, all that budgeting, all that nuances of how you're going to make it more possible and not fall foul of the sort of different criteria banks and building societies have. So we wanted somebody who's going to help you facilitate that to get your dream home. So she's going to be on the panel too. So they are all the panelists, and it's going to be an exciting event. I mean, I can't wait. I'm looking forward to it. So make sure it's on the 24th of September, 6:30pm to 7:30pm at the General Assembly. It's in Whitechapel, East London. It's easy to get to. I say East London, it's pretty central from my point of view. And I really want to see you all there. There's a lot of podcast listeners coming, but I want all of you to come, as many as we can, because we can keep extending, hopefully, the number of people we can have at the event, and we want to sell it out. So, interestingly, September is a busy month for me doing talks and bits and pieces. I'm doing another panel discussion for an event called Financially Fabulous, which is based around good housekeeping, and another publication called Red. So, it's a female-orientated event, and it's a paid for. You have to pay £25, I think. I think that's probably sold out now. And that's beforehand, but the Money to the Masses event is the main thing. It's free, because all our events, we want them to be free for people to come along so you don't have to pay. And of course, I'm doing other talks as well to people within the industry about various different things, about what we do, about where the money world is going, because don't forget, we deal with lots of the up and coming, exciting tech companies out there as well. So I'm sure people will get to see me at some point.
Good stuff. So that's it. Make sure you're at the event. The details will be available on the podcast, on our YouTube channel as well. So what have we got coming up on the rest of this pod? You mentioned it's quite investing focused.
We're going to do an investment focus, I think, today. And I've already given you a money tip to do with travelling based on my own unfortunate circumstances. But investing. Now, stock market crashes, they don't occur as often as people think. So there was some research that we've done recently, and I've talked about how markets behave at all-time highs. How likely are they to crash 10% or more from an all-time high? And it's actually less likely than the market carrying on to new all-time highs. So go back and listen to that podcast episode. It was the last couple of shows ago, I think. But what about the lessons you can learn from previous stock market crashes? Now, when I was away, I was supposed to be relaxing. I'm not meant to be doing money stuff, but it's very hard not to when you do it all the time, and you sort of eat, sleep, live, breathe money and trying to teach people. And I was reading some research actually about the lessons of stock market crashes. And now there's some research done in association with Bloomberg that related to 68 countries. So we're talking developed world and we're talking emerging markets. And they looked at crashes for, 125 crashes in stock markets of 40% or more across all of these markets. And they had a bizarre way of summing up the amount of years that covered, rather than just saying it covered 50, 100 years. They said it covered 1,878 years.
Because they totaled it all up amongst all of them.
Yeah, which I don't know why, but I find that not only confusing, but slightly disingenuous. But anyway, the point was, it was a very exhaustive piece of research. So you might think, how often do crashes happen? So the frequency of drawdowns or crashes in stock markets in developed worlds, they happen something like between 10% and 20% happens every 2.8 years. In emerging markets, it happens slightly more frequently at 1.9 years. So you might think that emerging market crashes or corrections of 10% or more happen far more frequently than they do. They actually happen more frequently in developed world markets, but not crazily so. So what about bear markets? So when the market falls 20%. Now they happen every 5.4 years in developed markets and every 3.9 years in emerging markets. So it's much more frequent. And if you look at 30% falls, then they don't actually occur as often as people think. That's what people worry about. It's 9.3 years in developed world markets. So that means almost once a decade. So a 30% fall in stock markets is a once in a decade event. In emerging markets, it's 6.7 years, a bit more frequent. And a major correction, so you get a 40% fall, only occurs once in every 15 years in developed world markets, 10.7 years in emerging markets. So it's a decade event in emerging markets. So that is not as often as people think. So we have a lot of people worrying at the moment that we're going to get another 40% fall, something like a dot-com bubble bursting, that kind of event, or a financial crisis event where after that financial crisis markets collapse. But the evidence shows they don't happen as frequently as people think. So we fear these things, but they don't occur as often as you need to worry about. Now, of course, they do occur, but what about the recovery? Because the fact that they do occur, that's life. We have the ups and downs, and then we're going to have these periodic corrections. So if we look at the recovery of these things, because that's what's important, the recovery time after up to 30% correction, so 30% or less, is typically 1.2 years in developed markets and 0.8 years in emerging markets. So we have this case where the corrections are more frequent in emerging markets, but you recover from them more quickly. And that's partly because of the volatility, the ups and downs you see in emerging markets. Now, that shows that the recovery is quite quick, but it does obviously depend on the severity of the drawdown. Where it gets a little bit more worrying is if the drawdown is 30% or more, then the recovery time suddenly extends much more. So we're talking typically at least 6 years in a developed market. And if you're in emerging markets, it goes up to 5 years. It's still that little bit less.
So it's gone from 1.2 year recovery on a sort of 30% to once it goes above that 30%, 40%, it's going from 1.2 years recovery to like 6 years.
Yeah.
Like 4 or 5 times the recovery time.
Yeah. And if you look at some markets, so the Japanese market, when it collapsed in the late 80s, they're still trying to recover from that. So this is why buy and hold strategies, they say work over the longer term and they will beat other strategies. This is why it's not always true, because it depends when you bought.
Yeah.
So if you buy in and you bought it at the top, put all your money in, and then the market collapsed, then you could be waiting 6 years just to get to the break-even point again. And that's why corrections and crashes and bear markets, while they're obviously, you don't want them to happen, they don't happen all as often as people think, but they're not the things you really need to worry about. What you really need to worry about are the 30% falls, the next financial crisis type of stuff. So they are the ones that really damage your wealth. And for investors, that's the one where their wealth is eroded and it takes far longer for them to recover. And if they're nearing retirement and that happens, that's when it can suddenly really hit them if they start to try and draw down on it, which is why you need to start preparing when you get towards retirement. We did a podcast on that. Somebody asked me what sort of asset mix you should have. That's why you have this kind of lifestyling idea where you start to move from risky stuff to more safer or lower risk investments.
And that's to do with your age and subtracting stuff. We've covered that on the podcast before, haven't we?
Yeah, and it's just about trying to you focus more on capital preservation than you do on the growth aspect of it. So instead of trying to shoot the lights out, just trying to keep the lights on. And the interesting thing is, for investors, I've been reading a book as well while I was on holiday. I've been doing a lot of reading, and there's an interesting
Mills
book.
and Boone?
No, it wasn't. It was an investment book. But what I did read a novel, actually, a book called 55. If you've not heard of it or read it, do go and read it. It's based in Australia. I've veered off the money stuff here, but it's based in Australia. It's a bit of a thriller, really, but it's two guys come out of the wilderness and both claim that they've been abducted by a serial killer and they've escaped. But I'm not ruining the book. This is on the back. This is the blurb on the back. But the interesting thing is they both come out with the same story, and each of them accuses the other person of being the serial killer who had them locked up and they got away from, and they have to try and work out what's going on. I've given it to a lot of people, and they've all really enjoyed it. And I think it's now going to be turned into a film. So it's called 55, the number 55. Anyway, one of the books I was reading is based on investing. I'm thinking of reading loads of investment books and money books in the next year as quickly as I can, to pull together some of the best bits, partly for the podcast. I mean, I read a lot anyway, but trying to condense a lot of that down. But one of the books that I was reading made a couple of good points about the psychology of investing. There was some research that was done to show, firstly, that people in bull markets tend to become more aggressive and they tend to take on more risk. But when markets start to fall, they tend to then put their foot on the pedal and take less risk. And it's a lot of it's down to psychology, but some of it is physiology as well. It's about the way your body reacts to fear, and it starts to deliberately make you more cautious. It's because if you want to survive in the wild, you've got to be, if there's something happens, then certain chemicals are released in your body that make you take more or less risk. And that's why it makes us bad investors. So the point is, when you get these crashes that happen that may be short-term, smaller ones, overreacting to them is human nature, and you need to try and stop doing that. So you need to have a process, whatever that is, whether it's 80-20 investor, whether it's just the fact you've got to sit on your hands, stop looking at your portfolio, then you need a process to try and cope with that. But the other interesting point is that depending on when you invest, when you start investing, it has a disproportionate impact on your behavior, your perception of risk. So this is true of everything in life. So your memories when you were young have a bigger impact on you as an adult than maybe some of your more recent ones. It's just the way when you learn something for the first time or you encounter something for the first time, then whatever happens has a disproportionate impact on how you'll behave in the future.
That's why I'm a negative Watford fan, because the first game I went to, they lost 3-0.
That is a perfect example of why being a Watford fan, or Andy, his view is very pessimistic about the prospects of Watford. But in investing terms, that means that if people enter a market when it's flying, they will start to probably take on more risk and be more bullish, and it will impact how they behave in the future. Equally, if you invest during a time when markets crash, then you may become completely fearful of all types of investing and therefore bail out before it has time to recover. So that's about being human. So the message of this part of the podcast is that these corrections occur. They don't occur as frequently as you would expect, but neither can you predict when they will occur. So there's no point trying to predict when the next black swan event will occur, because you won't get it right. But you want to try and avoid them if you can, because they are the things that damage your wealth the most. But if you can't predict them, and you shouldn't, then what does that mean? And the answer is you should just prepare for them. So you should try and prepare your portfolio that can be diversifying. It doesn't mean just diversifying in, say, equities, just going, right, I'm going to have American, I'm going to have European. Just geographically diversifying within one asset class won't necessarily protect you, because in these kind of Armageddon events, they are global. So everything falls. So it isn't that necessarily the America will hold up. Everything's going to sink. So it will be about holding different types of assets. That's why you diversify. But the other thing to bear in mind is that I'm a big fan of stress testing portfolios, and we talked about that recently on the podcast. Now, 80-20 investor members will know that I have just updated the stress test tool that we produce on there. And what it is, there are a bunch of scenarios. So I've particularly picked out Brexit, an escalation in the US-China trade war, two of them, currency wars. Just trying to remember the others I've got on there. But there are a number of scenarios that could happen, and I've gone back and looked at periods of time in the past where those risks have flared up and looked at how things have behaved. So therefore, any fund, I can give it a score based on like stress testing it in the scenario to see how it might perform. And by doing that, you can then prepare a portfolio in case of an Armageddon event or a black swan. It won't stop a black swan event hitting your portfolio, because of course when the market falls you're going to fall as well, but it may just mean that you will fall less. Now, to encapsulate that and to show what I mean, I did that back in May. I'm very conscious of this given where we are with markets and what's going on. And my portfolio in the last month in the month of August is been doing really well. Now, the market on average, so the mixed sector, which is 40% equity to 85% equity, that sector is quite punchy for comparison to me. I like to give myself tough benchmarks because I don't have 80% equity. But what's happened is that the average return in August has been minus 2.62% for the average fund in that sector. That's just the average. You can imagine quite the range has gone down. And out of the 223 funds in that sector, only 4 made a profit. All the others lost money. Now, my portfolio, which would be, again, is comparable to those kind of funds, has made a profit in August. And part of that reason it's managed to do that is because there was a focus on stress testing what could happen with the trade war. It was one of the ones I carried out at the time. And of course, in August, if you follow midweek markets, we looked very much like May, where Trump escalated the trade war. Now, of course, that can reverse. And so, therefore, I'm not sitting there counting my chickens and everything and gloating about it, because markets can change and conditions change. But it's just to highlight that that's why you do it. So it's about preparing. And there aren't many tools out there that can help you do it. I made one deliberately on 80/20 Investor because of that. So if you've not heard that podcast about stress testing and focusing on the downside, go back and have a look through. It's very recent. You will be able to find that. So that's the message, Andy. Prepare a portfolio in case if you're worried about those 40% corrections. But of course, time is the best healer. And that's for lots of things in life, because of course, like we said, the recoveries are 6 years. You just need to make sure your time frame is extended, and you extend your time frame. You don't necessarily have to sit in the things that are going down. You can review your portfolio, but if you increase your time frame, then the price you got in a market at has less and less bearing on, ultimately, less of an impact, I should say, on your eventual return.
Good stuff. I enjoyed that. Right, what have we got coming up?
A question.
Oh, I've got that.
You've got that, Andy. Question from a reader. It's from Jack, who wrote in. It's about, the overall title is it a good time to start investing? So, Andy, take it away.
So yeah, Jack goes on. Hey Damien, I've become a big fan of the podcast show over the previous few months, and I've decided to get my finances in order. My query is it a good time to start investing? I'm 24 years old and I've just opened a stocks and shares lifetime ISA with a full £4,000 annual quota deposited and ready to go. I've also done my own research on the funds I'd like to invest in with a diversified portfolio in mind. However, with Brexit uncertainty, the USA-China trade war and the potential for a recession on the cards, as you've been talking about in your midweek market shows, is it a good time to start investing? Would you perhaps advise waiting until after Brexit and the USA-China trade talks is a little bit clearer? What would you advise? Or would you perhaps advise a dollar cost averaging strategy beginning now, seeing as though he's still young? He also doesn't want to miss out on jumping in at the bottom if there is a market crash or recession on the cards. So what do you think, Damien?
It's a good question.
It's nice to hear from younger listeners as well, because we know you're out there, but I feel like it's the older listeners that tend to get in touch more. I don't know why that is.
This is why the event is, again, going back to that, is great, because when we did the pub meetup last year, it was we had met a whole range of people from, I think the youngest people there were like probably about 20, even 19, 20, all the way up to like nearly 60, and there was men and women. And it's to be able to see those people, you really get a feel for who we do this podcast for, who likes it and everything like that. That's why I want to meet everybody at the event and talk to them afterwards, because I know there are young people out there, so we need to make sure we cover topics for them. The question itself, I think, is a really valid one. So he's basically sitting in cash, wanting to know when to invest. Now, of course, one thing is, I noticed he said it's a lifetime ISA, so is he thinking of buying a house? When is that? If he's thinking of doing it in the very near future, then I wouldn't invest really anyway, because if it's going to be within the next 12, 18 months, there's always the danger the markets could crash. I mean, the general rule of thumb is less than 5 years, then you might not want to be investing anything anyway.
Of course, with a lifetime stocks and shares ISA, that can go towards pension contributions as well. So maybe it's long term.
Yeah, it could be.
We just don't have the information.
No. And the one thing I would say is, just because you put a lump sum into a lifetime ISA and it's sitting there ready on the platform to invest, as Jack's pointed out, and many people might not realise, you don't have to put it all in at once into the into funds, into the stock market.
So it can sit in like a cash pot.
Yeah, you won't make any money out of it, but it can sit there and then you could start to put it in stages. So the idea, if you're worried about a correction, then the evidence shows, and we've done research on 80/20 Investor to prove this, that you would drip in, because that means put in a monthly amount of a certain amount over time. And the best way to do that is, if you're going to do it, is to set a set amount and you do it at a regular interval. So you might say you're going to drip it in over 6-9 months, and then you divide the amount you've got down and you put it in, because then if the market crashes, then you're buying more units at a lower price. So you're getting more, and when you're getting more bargain, basically, more bang for your buck. It's called pound cost averaging. And Jack calls it dollar cost averaging, but that's probably because he's doing his research on the internet and has seen it called that. It's a bit like if you go to the shop, you're buying more of a product at a cheaper cost, so you can get more. And then with investing, when the price then recovers, you're going to make more money because you bought stuff at a lower cost than if you'd put it all in at the beginning. So the answer is, if he's worried about that, then you drip in. If he's not, then you would put the whole amount in straight away. Now, the problem is trying to call the market is what he's saying, because is it a good time? Is it about to crash?
He's asking you, with your crystal ball,
yeah,
what do you think? And I suppose it's like,
yeah, and the answer is I don't know.
Yeah.
Equally, he wants to catch the bottom. If we could do that, then we would all be rich, and it's not.
We'd be living on an island.
Yeah, and it's not possible. And what would happen, as I talked about that psychology, as the market went down towards the bottom, which you don't know you're there yet, people don't jump in. That's when people are fearful. That's when you should logically jump in, but your human nature will stop you because you'll be as fearful as they are. It's a bit like there are only certain people, when there's something event going on, a car crash or something bad happening, run towards it. Most people run in the opposite direction, and of course that's really when you get to a market crash and people look back in hindsight, they'll go, oh, if only we'd invested at the bottom, we'd have made a killing. But they won't do. So the answer is, it never is a good time or a bad time to start investing. And if you're young and it's going to be long term, then you can get into the market, but you can drip in. I mean, if he's worried about the market crashing, then he could drip in over time. He also doesn't have to take as much risk. He can diversify. He can take less risk if he wants to, and over time start to move it out of things like bonds into equity. So the thing is, I think it's interesting, because if you go back to when I started running my 50k portfolio, which was in March 2015, markets were all-time highs, and I would have said exactly the same thing then as I am now, where, yeah, I don't know if markets are going to crash, and look where we are now. The portfolio is up 35%, and you look back now and say that was a great time to start investing, but it didn't feel like it. And the answer is, it never feels like a good time to start to invest, because there's so many headlines out there scaring you, and we just don't know what's going to happen. So if you're worried about it, you're worried about the market falling, drip in. If you don't, and you have a long time frame, again, like I said, extending your time frame is the best healer of any portfolio. Your investment time frame I'm talking about, then you would invest up front.
Good. And I suppose if you want a little bit more hand holding or sort of insight or analysis, obviously Jack looks like he's absolutely fine. He's doing lots and lots of research. You can sign up to 80/20 Investor, where you can do a lot of that sort of number crunching. Again, you haven't got a crystal ball, but you can give people as much analysis and insight so they can make their choice.
Yeah, and I had a really good email, which I've not read out on the podcast, and it was from somebody who's been doing 80/20 Investor for a year, and they were talking about how the journey's been a great one for them in empowering. They had invested in lots of different things outside of 80/20 Investor, peer-to-peer accounts, cash ISAs, other types of investments, and they were really happy with the 80/20 Investor part. But the point was, that I loved about the email, was that they are doing other things as well. And you can have lots of processes. It's about having lots of different things. But the biggest point was that they were now more confident in making their own decisions and appreciating the risks. And this particular person started their investment journey in 2018 in, I think, September, October, right before the market crashed. And we've only just really recovered from that in terms of the markets. And they held their nerve through that crash. And they've come out the other side as a result in a positive way, and they're happy. But it's a very good anecdote, because it's just the same as this person, that you could go in and you think it's a good time to invest, and then you find out a month later that it's not. And that person said they'd wished they dripped in, and the power of dripping in they've done over time, has been a real positive. So if anything, that is probably one of the best anecdotes and answers to Jack. There was somebody who thought they went all in, got hit when the market fell, but held on, and the market recovered, but they were then started dripping in the rest of their money over time, and they wish having learned almost the hard way. But of course, if markets had rallied massively, that person would be sitting there thinking, I did the right thing by putting it all in at once.
Yeah, good stuff. Okay, we're done on this week's
We're done.
podcast. Really enjoyed it. If you want to get in touch with Damien, you can do so as always. It's at Money to the Masses with a number 2. You can contact Damien by email, damien@moneytothemasses.com. Please do check out our YouTube channel. We're doing lots of stuff on there. We want you to hit subscribe. If you haven't done it already and you're not going to come to the event or anything, if there's one thing you can do today that would really help us out, go onto YouTube if you have an account on there and click subscribe, because we're really doing amazing stuff over there.
Yeah, and also do review this podcast. We've not had a number of reviews for a month or so, I think, when I looked. And please do leave a review if you like this podcast. I love getting your emails. We're about to put up a new wall of love in the office, which we'll show you on social media when it goes up. So your comments and things are put in a wall in an amazing bit of wallpaper, decoration, decal, whatever you want to call it. Because the old one had to be destroyed when we moved offices and knocked the wall down. But that's going to go up. So please do leave your reviews. But most importantly of all, go to moneytothemasses.com/events and sign up for our event, Building a Champagne Lifestyle on a Lemonade Budget.
Good stuff. We want you there. And we're done for this week, and we'll see everyone next time.
Until next time.